Hi guys, my name is Tenor. I work in finance. Today we're going to be talking about the VIX. Volatility has been rampant in the market recently with all the tariffs threats between the US, Canada, and Mexico. What is the VIX? It's designed to measure the market's expectation of 30-day implied volatility of SPX options. Remember that the SPX is the index used to track the S&P 500. 30 data expiration options are used to calculate the VIX. For a VIX reading of, let's say, 20, the market expects the annualized implied volatility to be 20% over the next 30 days. The 30-day options are saying, hey, we expect the S&P 500 to be either plus 20% this year or down 20% this year. But we can actually convert this number to a more usable number by putting it into monthly or even daily terms. We take the VIX number 20 and then we divide it by the square root of 12, we get 5.77%. What that tells us is that the market is expecting the S&P 500 to move up or down around 6% within the next month, 1.26% in the coming days. Implied volatility is an estimation. It's all derived off of the price of option. So if option demand is high, implied volatility is high, that doesn't necessarily mean that that is what we're going to see in the market, right? And usually realized volatility is lower than implied volatility. Rules of thumb here when you're using VIX, especially when you're selling options, is that the SPX affects the demand for SPX options, and that a higher VIX makes SPX options more expensive, which is great for option sellers like myself. When the VIX is less than 15, that's generally considered low volatility. 15 to 25 is a normal range. 25 to 35, like we have right now, is elevated volatility. There's a lot more uncertainty. A lot of people are rolling off their risk, but the demand for options is very high for protection. Anything greater than 35, that is high fear, market turmoil. That's like a market crash, 2008. Like that is the level that we're talking about.